Hello everyone, hope you're having a great week. My name is Drew, the host of Never Behind, wanting to share insights from well-known investors or investors that have been in the market for a long time with plenty of experiences so that they may provide insights of the market that may help you with your personal investments and never be behind the trends. Now, I'm sure if you have been in the market and have been watching YouTube for some time, you would know who Jeremy is and may have watched his financial educational videos. I personally think Jeremy does an amazing job and really puts a ton of effort into updating his subscribers with great insights and with updates on what is going on in the market every day. A few days ago, when the market was tanking after the FOMC meeting, and when Powell came out saying that we may have another hike based on the reports coming out, I was doing my research to see what other people had to say about the situation and their insights. And although most of the people on the news or YouTube had very similar opinions, I really think Jeremy came out with one of the best insights and wanted to share them with you all. In this video, I will be sharing what Jeremy mentioned on his YouTube channel regarding the increase of credit card losses rising at the fastest pace since the great financial crisis. For me, this insight was shocking and gave me a broader view of the market, and hope it also helps you with your investments as well. So with that, let's get into the video. Now, before I get into the video, I wanted to share that Moomoo is having a great promotion, giving out 16 free stocks including either Tesla or Google. If you open an account and deposit $100, you get 5 stocks for free. And if you deposit $1,000 and just keep it for 60 days in your account, you get a total of 15 free stocks. And if you deposit $5,000 and keep it for 60 days, you will get 15 free stocks plus either Google or Tesla. So if you want to receive a potential of 16 free stocks, make sure you click the link in the description below.
Credit card losses are rising at the fastest pace since the great financial crisis. Goldman Sachs predicts credit card losses will continue to climb through the end of 2024 and into early 2025. What is unusual is that the losses are accelerating outside of an economic downturn. That is scary because you've got to ask yourself, this is with 3% unemployment. What if we go to 5%? What if we go to 7%? What if we go to 9% unemployment? What if we went to 11%? What does that mean for credit card losses if that were to happen? Now, here's how all this plays out, and here's why it matters so significantly, okay? It's way bigger than just, oh, somebody didn't pay their credit card. No, it's way bigger than that, okay? And remember, we're talking about they're rising at the fastest pace since the great financial crisis. So, somebody doesn't pay their credit card. Johnny, okay? Johnny doesn't pay his credit card. He's got $5,000 in credit card debt. So boom, credit card company has to eat the loss on that. They're probably going to send debt collectors after them, and they're going to receive 1 million calls for the next 3 years from debt collectors trying to collect that $5,000, okay? Boom, that's a situation that happens, right? So Johnny's credit card is obviously going to be shut off because he didn't pay his Discover card or his American Express or whatever, right? Guess what else is going to happen to Johnny? Johnny's credit score is going to drop. And it's not going to drop a little bit, it's going to drop a lot. If he just doesn't pay his credit card and just, that is what it is, his credit score is going to drop significantly. So now, Johnny's going to have limited to no credit card access for quite some time, because usually it takes years to roll that off. Years. When you burn credit card companies, that stays on your credit score for years to go in the future. And then eventually it finally drops off. So then you're in a situation where good luck going to get a car loan. If you even dream to get a car loan, you better be ready to pay such a ridiculous interest rate. It's not even funny. And you're probably not going to be able to pay the payment plus that crazy interest rate they're going to throw at you, because they're probably, I've gotten car loans. I've been in that office with folks that didn't have very good credit. Let's just put it that way. And you know what their credit, those companies ended up charging them? 20% plus for an auto loan. 20% plus. Most folks can't afford that. That's what happens if you burn credit card companies. And you're stuck into a situation where all of a sudden you're like, oh man, can I get a credit card? No, you're not going to be able to get credit card. So you have limited to no credit card access after that. Plus limited to no loan access period after that. Then what ends up happening? Well, guess what? Spending's going to drop, because now that guy can't go buy a new car. Now he can't spend on a credit card. He can't go to Texas Roadhouse and go spend $80 on dinner. So spending drops. And you go ahead and times that out by potentially millions of people, right? If you do have some sort of recession, and what that ends up equaling out to is a recession. And it depends on how many people are really affected, is how big the recession is. For the great financial crisis, it was a lot of people. And so it very negatively affected a lot of people, and it negatively affected the economy in a massive way that took years to come out of.
Personally, I really think a lot of people are in the situation where you need to use your credit card in order to survive, even though you may not have enough money in your account to pay off. Now, although inflation is coming down, the food and energy prices are still very high, and these are the prices that really matter to the average people since they will need to eat and drive no matter what happens to the economy. Now, since food and energy prices are still high, the spending on the credit cards will stay high and accumulate as time goes by as long as inflation is maintained in this high level. And therefore, at some point, people will finally start not being able to pay off their credit card debt, which will start the vicious cycle that Jeremy was explaining. Now, what got me more worried is that these credit card losses we are seeing now is happening in a market where the unemployment rate is only 3.8% and indicates a pretty strong market. Now, with the high inflation, high Fed fund rates, and also the UAW strike and over 75,000 people at Kaiser going on strike, I think there is a high possibility that the unemployment rate will go higher. And therefore, if you lose your job, there has to be more people not being able to pay off their credit cards, and this will get the market in a very, very dangerous situation in my opinion. Now, on the next part of the video, Jeremy has done an amazing job analyzing the history of the American debt status and what happened in the Great Financial Crisis. Now, this insight personally actually blew my mind and got me more worried about the situation we are in right now. So let's see what Jeremy had to say about the debt level in 2008 and how that compares to 2023.
Now, this is where this crazy phenomenon comes in, right? Which is where we essentially witnessed actually like total debt going down after the Great Financial Crisis, which usually how this works is debt's going to increase almost every single year. Literally. Housing debt, non-housing debt, meaning credit card debt, auto loan debt, almost everything should increase almost every single year. That's the way it is. Assets should increase, liabilities should increase. That's just the way it should be almost every single year. But we had a phenomenon for several years where debt fell in the United States of America, which is mind-blowing to even consider and contemplate and think about, because we're a debt country, and like to think about our debt actually going down for a few years is wild. But that's what happened. But why did it happen? Well, guess what? All these people burned a lot of credit card companies, either purposely or because they had to, because they lost jobs and then they, fell out of work and whatever. And guess what? Their credit scores tanked in a massive way. And then even if they wanted to get credit cards, they couldn't. Even if they wanted to go get an auto loan, they couldn't. Even if they wanted to buy a house, they couldn't because their credit was crap. And so that's why we saw a $1 to $2 trillion debt or drop in total debt balance during the Great Financial Crisis and coming out of that over the coming years. And then finally, it bottomed around actually like 2013. So it went down for like 4 or 5 years straight, folks. And then guess what? Everybody's credit scores started to get fixed again, and people started taking out credit card debt again, auto loans, and boom, boom, boom. And we had a great economy for a long time. So if you're talking about a situation here, folks, where a bunch of people start burning credit cards, they're going to ruin their credit, and it's going to last years. And it will be a damper to consumer spending for years. My take on all that is it's not a good situation. What the market's doing is the market's basically telling us that 6 to 9 months from now, we're going to be in recession. The Foot Locker is not going to be putting up good numbers 6 to 9 months from now. Texas Roadhouse is going to be reporting down comp store sales 6 to 9 months from now. Cheesecake Factory is going to be reporting down comp store sales 6 to 9 months from now. And that's the game plan. Let's say that happens. Why buy these stocks now? Why, be buying Texas Roadhouse over the next 3 to 6 months if, let's say, 9 months from now, the business is bad? Those stocks will bottom way before their businesses bottom. Stocks bottom way before their business bottoms. And when I say way before, I'm talking it can be anywhere between 3 months and 9 months before their business performance starts to get in a little better place. The stocks have already bottomed by that point in time. So these stocks falling right now is pricing in what's likely coming 6 to 9 months from now. By the time you get to that time period where it's like, wow, these numbers are bad from these companies, what's going on here? By that time, you could actually already have those stocks going up, which screws with investors' minds so bad because they're like, what the hell? This company just reported trash numbers and the stock's flying high. I don't get it. It doesn't make any sense. It was already priced into the stock before you ever got to that place.
Now, I really love how Jeremy used the US debt chart to compare 2008 and 2009 with what is happening in 2023. Now, as I mentioned before, I am very worried that the credit cards are closing at the fastest rate since the Great Financial Crisis, although the US unemployment rate is only 3.8%. So even with the majority of people still having jobs, there are a lot of people not making enough money to keep up with their credit card spendings. Now, if these types of strikes, the UAW and the Kaiser strike, strikes keep coming up and keep affecting the companies that are highly involved in these industries, this may cause another major layoff wave in the market, which then a lot of people will lose their jobs, and of course we'll have more credit cards closing for sure. And based on what Morgan Stanley has said, this trend of credit card closing may continue up to 2025, which hints that there may be a recession within that period. So I personally really think that we are in a market that we really should be careful with our investments and not follow the news or hype. I know that AI will be the future for sure, but does that mean the AI related companies are a buy at these levels? I personally do not think so, and always think that the best time to invest is when everyone is selling and not when everyone is so excited about the future of AI. Now, on the last part of the clip, I think Jeremy made a very interesting point where he said that although the business may bottom at some point, that doesn't mean that the stock price would bottom at that period as well. He is saying that 6 to 9 months of the future of that company is already priced in the stock, and therefore although we may predict that the business is going to bottom in about 6 to 9 months, that prediction is already priced in the stock price, and the price we are seeing now might be near the bottom. I think that was a really interesting point, but I guess time will tell, but I really think we should be very careful with our investments in 2023 and also 2024. So with that, I hope this video was helpful for your own investments, and I'm looking forward to seeing you all on the next episode.